John Ulzheimer is known as one of our nation's most recognized credit experts. Having worked for 28 years in the credit industry, John has become one of the most prolific speakers about credit and the go-to authority on answers to credit-related questions. Credit Countdown with John Ulzheimer.
Hey there, this is John Ulzheimer. I am a consumer credit expert. I have almost 30 years of experience in the credit industry. I've spent time at FICO, which is the company behind the FICO credit scoring system, and Equifax, which is one of the three generally recognized credit reporting agencies in the United States. And so the question that I get answered today is, can I refinance my credit card debt? It's an interesting question. I think most people, so what is a refinance? A refinance is a consumer who goes out and essentially borrows new money to pay off old money. So they're going to take out a new loan to pay off an existing debt obligation. It is, if you talked about kind of like what's the most common type of refinance, I think we have to clearly say that that's a mortgage. People commonly refinance their mortgage loans to either try to shorten the loan period from say 30 years to 15 years or to capture a lower interest rate, which is pretty common these days because the interest rates on mortgages are really, really competitive, very, very low, especially if you've got really good credit. Auto refinancing, not as common, but still absolutely something that occurs. Refinancing your student loans, absolutely something that occurs. So converting them from federally guaranteed student loans and paying them off with some sort of private loan. So that is not uncommon at all. But credit card, so refinancing credit card debt does happen. It's not really called refinancing though. It's more often called consolidation or balance transfer. So I'm going to repeat that since I'm staring out the window at the traffic. It's either called balance transfers or consolidation. So let me explain what those two things are. I'm sure you've heard the term consolidating your debt. What in the credit card scenario or in the credit card context, what that means is you're essentially moving the debt from one credit card or multiple credit cards to another newly opened card. So you're transferring the balance or balances from multiple credit cards onto a newly opened card. And generally the reason you would do that is because that new credit card is giving you some sort of a promotional interest rate offer, sometimes even as low as 0%. So essentially what you're doing is you know, if you really want to split hairs, is you're refinancing your interest accruing credit card debt with another credit card that has a interest rate or an APR of 0. So that's certainly one example of refinancing credit card debt. The second scenario is what's called, essentially you're using one type of loan to pay off the credit card debt. So you could certainly take out a home equity line of credit or money from a home equity line of credit. You could certainly take out a home equity loan. You could take out a signature loan. Some people call them signature loans. They're essentially unsecured personal loans. And you can use monies from those types of loans to pay off credit card debt. So again, this is often referred to as consolidation because you're taking money off of one credit card or multiple credit cards and you're paying that stuff off with a loan or monies from some form of a loan. Just be aware there's some risk in doing this, and the risk in doing this is if you're borrowing money that's secured by your home. So in other words, a home equity line of credit or a home equity loan. In both of those scenarios, you're pledging your house as collateral for those two loans. So if let's say that you take $50,000 out of a home equity line of credit and use that to pay off credit card debt, that's fine because, geez, if you have $50,000 of credit card debt, that's a lot. It's probably really, really expensive every single month. And using a home equity loan or a home equity line of credit to pay that off is going to save you a ton of money, and it's going to convert score-harming credit card debt into score-benign, either installment debt or non-problematic revolving debt, which is what a home equity line of credit does. So essentially, you're refinancing that money with money coming from somewhere else. In the scenario of the personal loan, that is unsecured, meaning that it's not secured by a home or any sort of piece of property. So in that scenario, you're actually going to a bank or a credit union, you're taking out a loan, a personal loan, it's unsecured, and you're using that loan to pay off credit card debt. So that's something that absolutely happens. It happens quite a bit. It's one of the primary uses of personal loans is to pay off credit card debt. And so in essence, you're refinancing that money, but you're kind of doing it in a disjointed manner because you're taking money from a loan with this lender to pay off credit cards with these lenders. But essentially, you still have the same amount of debt, it's just cheaper, and it's installment debt rather than revolving debt, so it's likely going to help your credit scores. So those are some methods whereby you can refinance credit card debt. If you have any other questions about the process, drop them in the comment section below, and I'll do my best to get to them. Thank you very much for watching, and have a great rest of your day.
For more videos and credit tips from John Ulzheimer, go to www.tradelinesupply.com.